He had already made his decision before anyone else even knew there was a decision to make. While millions of people were dumping their life savings into the market, feverish, sleepless, staring at green numbers on a screen and feeling like kings, Warren Buffett was sitting in a quiet office in Omaha, Nebraska, doing absolutely nothing. Not because he was scared. Not because he didn't have the money. But because he was waiting for one specific signal. A signal so precise, so ruthlessly logical, that when it finally appeared, he would move with more conviction than anyone on Wall Street. And when it didn't appear, he simply refused. He refused while the headlines mocked him. He refused while his peers made fortunes. He refused while the whole world called him a relic. And then the crash came, and it wiped out trillions of dollars in a matter of months, and the people who had laughed at him lost everything. Everything. And Buffett? He was fine. More than fine. Because of one signal that he has never, not once in 70 years of investing, ignored. Here is what makes this terrifying. The signal isn't complicated. It isn't hidden in some algorithm that only billionaires can access. It isn't locked behind a Bloomberg terminal or whispered at private hedge fund dinners. You could learn it in the next 15 minutes. But almost nobody uses it, because using it correctly requires something that the modern world has been systematically destroying in all of us since the day we were born. And once you find out what it is, you're going to look back at every investment decision you've ever made, every stock you bought on a tip, every time you panic sold, every moment you chased a rally because you felt left behind, and you are going to feel it in your chest. Because you're going to realize how close you were to the answer, the whole time, and how nobody ever told you. What is this signal? That's what we're going to talk about today. And I promise you, by the end of this video, the way you look at every single stock you've ever considered will be permanently, irreversibly changed. But first, I need to take you back. Back to a story that most people don't know. A story that happened quietly, without headlines, in the middle of the most chaotic decade Wall Street has ever seen. Before we get into it, I want to ask you something, and I genuinely want you to answer in the comments below. When you decide to buy a stock, what's the first thing you look at? The price? The trend? The news? Drop it down there. I read every single comment. And if this kind of deep dive breakdown is something you want more of, hit that subscribe button right now, and tap the like. It takes 2 seconds and it means the world. Alright. Let's go. The year was 1999. The world smelled like possibility. The internet was young and electric and everyone, believed they were going to be rich. Stockbrokers were celebrities. Day traders were buying Ferraris. A 23-year-old in a dorm room could open a brokerage account and, within 6 months, feel like a genius. The Nasdaq had gone up over 85% in a single year. 85%. People were quitting their jobs. Professors were dumping their pension funds into .com stocks. A shoe company with no revenue and a website was valued at over $1 billion. And then there was Warren Buffett. Sitting in Omaha. Doing almost nothing. His fund, Berkshire Hathaway, was being mocked in the press. Barron's ran a headline asking if Buffett had lost his touch. CNBC analysts were openly questioning whether the Oracle of Omaha was out of date. Too old. Too slow. Too cautious. A relic from another era of investing. The young wolves of Wall Street weren't looking at boring companies with boring earnings anymore. They were buying the future. And the future, they said, didn't need profits. It just needed a .com at the end of its name. Buffett didn't flinch. He didn't adjust. He didn't panic buy a single tech stock to quiet the critics. He sat there, in that modest office, reading annual reports the same way he'd been reading them for 50 years. And people thought he had lost his mind. But here's where the story turns. Here's the part that hits like cold water in the face. Between March of 2000 and October of 2002, the Nasdaq lost 78% of its value. 78%. Companies that were worth billions became worth nothing. Literally nothing, bankrupt, dissolved, gone. People who had taken second mortgages on their homes to buy tech stocks watched their entire net worth evaporate in 18 months. Marriages ended. Retirements were destroyed. Men and women who had done everything right, saved, worked hard, tried to build a future, found themselves starting over from zero in their 50s. Warren Buffett? He didn't just survive. He came out the other side with his reputation permanently cemented as the greatest investor who ever lived. Because he had used the signal. He had refused to buy without it. And in that refusal, in that quiet, stubborn, almost maddening patience, he protected himself from the greatest financial collapse of a generation. So what is this signal? What was he seeing that everyone else was blind to? The answer is going to surprise you. Because it's not a technical indicator. It's not a pattern on a chart. It's not some secret algorithm that only hedge funds have access to. It's a concept so fundamental, so grounding, that once you understand it, you will never look at a stock the same way again. Buffett calls it intrinsic value. Now, before your eyes glaze over, before you think you've heard this before, stay with me. Because the way Buffett defines intrinsic value, and more importantly, the signal he uses to know when a stock's price has finally aligned with that value, is something most people in finance have never fully grasped. Including the people who were supposed to teach you. Here's the idea in its rawest form. Every business, every single company on every single stock exchange in the world, has a true worth. Not the worth that people are willing to pay for it on a given Tuesday morning when the market opens. Not the worth that a Bloomberg analyst assigns to it after a conference call. The real worth. The worth based on the cash that business will generate for its owners from now until the end of time, discounted back to what that future cash is worth in today's dollars. That number, that intrinsic value, is what Buffett is always calculating. Not the stock price. The business value. And the signal he waits for is the moment when the stock price falls significantly below that intrinsic value. He calls it the margin of safety. It's the gap between what something is worth and what the market is currently charging for it. And Buffett's rule, his ironclad, never broken rule, is that he will not buy without a meaningful margin of safety. Period. It sounds simple. And in a way, it is. But executing it requires something that is almost impossibly rare in modern markets. Patience. Not the patience of waiting a week. Not the patience of holding through a bad earnings quarter. The patience of waiting years. Sometimes a decade. The patience of sitting on cash, real cash, uninvested, while everyone around you is making money, while the headlines are screaming that you're wrong, while your friends and colleagues are doubling their portfolios on momentum plays and meme stocks and AI euphoria. The patience to say, not yet. Not without the signal. Buffett told his biographer, Alice Schroeder, something that stopped her cold during their interviews. He said that the stock market is a device for transferring money from the impatient to the patient. Read that again. A device for transferring money from the impatient to the patient. Every time you've ever felt the urge to chase a stock that was already running, every time you bought something because it was going up and you were afraid of missing out, you were on the wrong side of that transfer. Now here's where it gets personal. Here's where this stops being about Warren Buffett and starts being about you. Think about the last stock you bought. Think about why you bought it. Was it because you had carefully analyzed the business? Had you estimated how much cash that company would generate over the next 10 years? Had you compared that number to what the market was asking you to pay? Or did you buy because of a tip? Because of a tweet? Because the chart looked like it was breaking out? Because someone on a podcast said it was the next big thing? There's no judgment here. Every investor on earth has bought for those reasons at some point. But that's exactly what Buffett is warning against. That's the behavior that turns ordinary people into bag holders. Into the ones left holding the stock when the music stops. Let me give you a concrete example. And this one is going to feel uncomfortable for some people, because it's recent. In 2021, a company called Rivian went public. Electric vehicles, the new frontier, the Tesla killer, the future of transportation. On its first day of trading, Rivian was valued at over $100 billion. $100 billion. This was a company that had delivered fewer than 2,000 vehicles at the time. That's it. 2,000 vehicles. Zero profit. Hundreds of millions in losses. But the enthusiasm was volcanic. The stock went parabolic. Everyone was talking about it. Buffett didn't buy a single share. Because the signal wasn't there. The intrinsic value, the real, calculable, business-based value of what Rivian was actually worth as a cash-generating enterprise, was nowhere near $100 billion. The price and the value were not just misaligned. They were in different galaxies. By 2022, Rivian had lost over 80% of its value from its peak. The people who bought at the top, driven by excitement and FOMO and the feeling that they were investing in the future, had lost most of their money. The people who waited for the signal, or who never bought at all, kept theirs. But here's the twist in this story that almost nobody talks about. And this is the part that will change how you think about not just Buffett, but about markets themselves. Buffett's signal, the margin of safety, doesn't just protect you from losing money. It creates the conditions for extraordinary gains. Because when you buy a business for 60 cents on the dollar, when the market is, for whatever reason, offering you a genuinely great company at a price far below what it's actually worth, what happens next is almost inevitable. The market corrects. Not immediately. Not always on your timeline. But over time, markets are extraordinarily efficient at recognizing value. And when they do, the investor who had the patience to buy at 60 cents on the dollar watches their investment compound, not just recover, compound, as the stock price rises to meet the intrinsic value and then, if the business keeps growing, surpass it. This is how Buffett turned $1,500, his entire life savings at 20 years old, into one of the greatest fortunes in human history. Not by being smarter than everyone else, though he is extraordinarily smart. Not by having better information, though he reads voraciously. But by being willing to wait. By refusing, absolutely refusing, to act without the signal. There's a story Buffett tells about his mentor, Benjamin Graham. Graham was the man who invented the concept of value investing. He was teaching at Columbia Business School, and Buffett, still a young man, still hungry and brilliant and searching for his framework, walked into Graham's class and had the intellectual experience of his life. Graham taught him that the stock market was not a measuring machine. It was a voting machine. In the short term, stocks go up and down based on the collective mood of millions of investors, their fears, their enthusiasms, their irrationalities. But in the long term, always in the long term, the market becomes a weighing machine. It weighs actual value. And actual value wins. That insight lodged itself so deep in Buffett's thinking that it became his foundation. His North Star. Every decision he has ever made as an investor has flowed from it. And here is where I want to bring this home. Here is where the narration shifts from history into something that actually applies to your life, your portfolio, your future. Most of us are not going to become Warren Buffett. We're not going to spend 70 years reading annual reports 12 hours a day. We're not going to have the emotional discipline of a man who watched the market crash in 1987, in 2000, in 2008, in 2020, and never sold a single share of his core holdings out of panic. That kind of equanimity is rare. It might even be superhuman. But the signal is something all of us can learn to use. It starts with a simple question. Every time you consider buying a stock, before you check the chart, before you look at the price, you ask, what is this business actually worth? Not what people are paying for it. What is it worth, based on the cash it generates, the moat it has, the durability of its earnings? And then you ask, is the current price giving me a meaningful discount to that value? Is there a margin of safety? If the answer is yes, if the price is genuinely below what the business is worth, then the signal is there. You can act with confidence. Not certainty. Markets are never certain. But confidence, because you've bought yourself a cushion. A buffer between your analysis being wrong and your money being destroyed. If the answer is no, if the price is at or above what the business is worth, you wait. Even if the stock is going up. Even if everyone is buying it. Even if you feel like you're missing the opportunity of a lifetime. Because Buffett has proven, over 70 years of investing, that the opportunities that feel like the opportunity of a lifetime almost never are. The real opportunities are the quiet ones. The boring ones. The ones that arrive when everyone else is panicking and the price has fallen so far below value that buying feels almost irresponsible. In 2008, when the financial crisis hit and banks were collapsing and the entire global financial system seemed to be melting down, ordinary investors were selling everything. The fear was overwhelming. CNBC was running countdown clocks to economic collapse. People were pulling money out of the market in fistfuls. Buffett wrote an op-ed in the New York Times. The headline was, "Buy American. I am." He was deploying billions of dollars into stocks that had been crushed by the panic, companies with genuine value, genuine earnings, genuine futures, whose prices had been devastated not by any fundamental change in their businesses but by pure, irrational terror. He wasn't brave. He was applying the signal. The prices had fallen far enough below intrinsic value that the margin of safety was enormous. The signal was screaming. And he acted. The investors who bought with him in the fall of 2008 saw some of the greatest returns in market history over the following decade. The investors who sold, who let the fear win, locked in their losses and missed the recovery entirely. This is the final thing I want to leave you with, and it's something that goes beyond finance. Beyond stocks and portfolios and compound interest. Because what Buffett's signal really teaches us is something about the nature of value itself. About the difference between price and worth. About the danger of confusing what something costs with what it means. That lesson applies everywhere. In business. In relationships. In the choices we make about how to spend our time, our energy, our one irreplaceable life. The things that are most valuable are rarely the things that are most loudly celebrated in the moment. The real opportunities, the real treasures, are often the quiet ones. The overlooked ones. The ones that require the patience and the clarity to see past what the crowd is screaming about and ask the harder, more fundamental question: what is this actually worth? Warren Buffett spent his entire life answering that question. One company at a time. One stock at a time. One patient, disciplined, signal-driven decision at a time. And it made him the greatest investor who ever lived. The signal was always there, waiting. The question is whether you're willing to wait for it. If this changed how you think about investing, drop a comment and tell me what clicked for you today. Share this with someone who needs to hear it. And if you haven't yet, subscribe, because the next video is going to go even deeper into the framework Buffett uses to calculate intrinsic value, step by step. You do not want to miss it. The signal is patient. And now, so are you.